Hello, this is Rebecca from Seawolf Sustainability Consulting, and this is a Finance 101 brief explainer on some technical terms which are used in finance. And quite often friends, family, colleagues ask around some of these technical terms. It's not going into detail and it's in generalisations, but outlining some key concepts. So first, what is finance? Well, often this is the ownership or the claim to own a company, project or asset which is in the real economy. For example, that could be via debt, which is a type of fixed income instrument, which is also often called a bond. And a debt is essentially an IOU. I will pay you back at some point in the future a fixed amount, and I'll pay you some interest payments in the meantime. And fixed income is very sensitive to inflation. So as inflation starts to go up, typically, often the value of debt in the future reduces, and it's also highly correlated to interest rates. Secondly, the other type of ownership could be equity, otherwise known as shares. And this would be shares in a company, or it could be shares in a particular special purpose vehicle. So that's the ownership. Second, financial institutions. Well, financial institutions are the companies who deal in these types of transactions of debt and equity. You have banks. Banks typically have a license. They take deposits from customers, both retail and corporate customers, and use them to then give loans, and they also offer checking accounts and savings accounts. Secondly, insurance. So insurers underwrite risk. They have a good understanding of risk, and as they choose to underwrite that risk, they have some compensation which is paid, usually a premium which is paid by the person being insured. Lastly, there's investors in this small summary, and investors set aside capital for the long term and they invest that in companies via debt or equity, and they can buy and sell that debt or equity. Investors are often more long term, and that's not to be confused with trading, which is more around speculation and looking at the buying and selling of debt and equity, but typically over a shorter time frame. So very small summary of financial institutions. And why is this important with regard to sustainability? Well, with sustainability, decarbonisation, reducing emissions and moving to more sustainable practices will happen in the real economy. And finance and financial institutions have a role to play in having capital in those investments, in those organisations, those projects in the real economy. And after meeting their regulatory obligations, so making sure they meet regulations, to give some examples, insurers will underwrite, it could be new assets, for example, such as clean energy, wind, solar and renewables, to reduce the risk associated with them. Investors will provide capital. They'll own the shares in the companies which need to transition towards the low carbon economy. So they have a role to influence and to encourage that transition to happen as quickly as possible. And lastly, banks have a role both lending to those companies to help them move to more sustainable practices, but also via capital markets, where those companies are going and raising money on the markets via debt, or it could be via shares and IPOs, accessing new shares. Banks have a role to help facilitate that. So that transition can happen more quickly by allocating capital to companies, for example, in the clean economy, but also shifting and transitioning assets away from dirty companies, projects and sectors. Now, where can you find the information about how this is happening? Well, many financial institutions will publish annual reports which are available on their websites. In the US, there's the Form 10K, and there'll also be quarterly filings. as well. So every quarter, various progress reports on financial information. In annual reports, there will often be a disclosure called the TCFD, the Task Force on Climate-Related Financial Disclosures. And in that report, there's a description around the board, their role in acting on some of these issues around climate, the strategic information about how the company, the financial organisation is supporting the transition, risk management and how that's being integrated into risk management, as well as metrics and targets. Things to look out there are in particular any caveats, footnotes, looking for the scope of these reports, how they're described, and also any basis of preparation. So any estimates or assumptions that might have been used in those TCFD reports. So this is a very, very brief explainer, 101. Thank you for listening. If you're interested to find out any more, please let me know and have a good day. Bye.